Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the suburbs of Chicago with today's Tech Talk. It is Tuesday, August 30th, just one day left of the month, and then we roll into September. I can't believe it's already college football season, so weekends just got a little bit more exciting, and I guess unless you're a Husker fan like me who had a little rough start to the year, losing to Northwestern in Dublin, Ireland last weekend, but hopefully it's early enough in the season where they can turn the ship around. We won't see a repeat of what we've seen in the last couple years, but that is that rant. Before we get in the charts, we're trying to build our YouTube following, so if you haven't subscribed to our YouTube channel yet, go to youtube.com, type in Blue Line Futures. There'll be a red subscribe button down here. Go ahead and give that a click. There'll be a little bell next to it where you can turn on notifications, so whenever we put out content, you'll get notified. And we put out a lot of great daily content, not just in the agricultural side of things, but as well as energies, metals, currencies, etc. So again, if you haven't given us a follow on YouTube, we sure would appreciate that. Now that we got that out of the way, we can get into the charts. We've got four markets for you today. I don't think I mentioned that earlier. We've got corn, soybeans, lean hogs, and live cattle. To kick things off, we've got the December corn contract pulled up here. A little bit of a pullback in today's session, and we had talked about this big resistance area in the last couple reports. 677 to 682's kind of been an inflection point, really going all the way back to the spring. It was resistance in the at the end of March, and then it was the eventual breakout point at the very end of March. March 31st is where we broke out of 677, 682, and that kind of sparked a secondary rally up towards 750 and above. On the way back down, this area was offered as support at June 1st, and then was the eventual breakdown point here on June 23rd. So this 677, 682 has been a pivotal area for the market. And from a risk-reward standpoint, we noted in the last several daily grain express reports that we send out, we like leaning on the sell side because you know where you're wrong. The breakout and close above yesterday's highs would neutralize the bearish bias. So you're risking, call it 5 to 10 cents, potentially looking for a pullback towards 650. Now there is a little bit of a gap here which will act as first support. That's near 666, which is a little bit ominous, but there is a small gap there. That would be the first barrier that we need to see break down to really get us back towards those lows from the end of last week, which come in closer to 650. So again, from the risk-reward side, we like leaning on the sell side. Today's session, we did see weakness. However, if you're a bearish individual, kind of like myself, against these levels, you may have been a little bit disappointed relative to the action we've seen in the other markets. Outside markets were under heavy pressure. Crude oil was down, I think, roughly 6% at one point, and for corn to only finish down about a nickel, that's pretty impressive, all things taken into account there. So those are the levels we're looking at for corn and kind of how we're approaching it. Now moving over to the soybean market. Soybeans, we've had a bearish bias in the Grain Express too, looking for a pullback to the 50 and 200-day moving average, which we tagged to a T this morning. The low was 1408. Those moving averages came in 1405 to 1407. And then we rallied back towards this kind of congestion pocket, and this is what we've referred to it as. This would typically be looked at as a pretty bullish reversal, but we're going to want to see follow through. And as I mentioned with corn, there's a lot going on in the outside markets. You've got a lot of weakness in crude oil, which could be weighing on some of the agricultural products. You see a lot of weakness in the equity markets, which potentially means that we're going to have some rising concerns over future demand. So there's just a lot going on here, and you can easily get bought into these, oh, this is a bullish reversal. But if you look back, over the last month or so, we really haven't gone anywhere. We've just been kind of chopping back and forth in a fairly wide range, call it 1380 to 1480, and we're starting to narrow that range and consolidate. And eventually we will get a bigger directional move. Which way that is, TBD. Right here in the middle of the range and these moving averages, right in the congestion pocket. Don't see a whole lot of new positioning to be done here, at least in our point of view, going into the last trading day of the month. Now, moving over to the livestock side of things, we've got October lean hogs pulled up here, And we got in this gap that was left down here from July 6th, but we didn't fill it. And I'm surprised they didn't, because we were down there. You might as well just fill the darn gap. Nonetheless, we did rally, and we talked about this in last week's report as well. Kind of the low end of the range. The RSI not oversold, but definitely at the lower end of the range. So if you like scaling into a position, we talked about looking at this as a buying opportunity so long as we can defend these lows that were made back here in May and July. Break and close below there. You'll probably want to get out of the way because there's not a whole lot of significant support until you get closer to that 80 mark. Now on top of the technicals, you also have a fairly friendly seasonal, but that is in the June contract. So we are still friendly, lean hogs, and we were last week and remain friendly. But if you're friendly, you want to see some follow through on today's price action and a breakout above the 50 and 100-day moving average. That could potentially spark a bigger retracement to this breakdown point from August 18th, which comes in closer to 97. And so that's what we're looking at for lean hogs. Relatively friendly, but need to see some follow through after the past two sessions rally. I wouldn't be surprised to see us stall out a little bit, but need to get out above these moving averages to spark that next directional move to the upside. And lastly, wrapping things up with live cattle. We've got October live cattle. We've been kind of leaning on the bearish side of things, and we got a rally today back above what was previous resistance. And I don't think it's all that concerning that we got a big or a decent rally. I guess it was a big rally relative to what you would have thought with the outside markets. We were hoping we'd get a little bit more pressure towards these moving averages, which we've been referencing for quite some time now. The 50, 100, and 200 all come in between, 141.85 and 142.17. So with the outside markets under significant pressure today, and crude oil down sharply, and just you'd think that would affect the overall sentiment on future demand, and it didn't do that, and it rallied, which could mean that there's some good underlying strength. Now with that said, Jerome Powell's speech on Friday was quite hawkish, and he mentioned multiple times that some households will experience pain, and it looks like the equity markets are starting to take him a little bit more seriously, and if that persists, we could see this pressure come in and get us down towards these moving averages and eventually break below, again, if the outside markets continue to drift lower. And if we take out these moving averages, there's not a lot of support until you get closer to this 138 level. So those are kind of some of the things we're looking at here as we wrap up the month of August. If you've got any questions, please feel free to reach out to us. We're here to help. And remember, give us a follow and a like on our YouTube page. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.